Right, hello everyone. Thank you for joining our webinar today. The webinar is focused on tax planning for landlords, which is a very hot topic at the moment. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax Group, and I've got my colleague Alan Mill here. Alan is one of our senior tax managers, and Alan is a chartered tax advisor and has over 30 years of experience in advising people or clients on tax mitigation strategies. Today, we will be, as I said, we will be talking about the tax planning for landlords. There are different types of talks going on in terms of what options landlords have and how they can structure their property portfolio to benefit in the short and the long term. In long term meaning inheritance tax and passing it on to the next generation, and short term meaning reducing your income tax, annual income tax liabilities or corporation tax liabilities. But there is this is a very hot topic. It has been for a while, and because we come across a lot of landlords who simply have worked really hard and collecting a portfolio of properties, but they don't know what to do from a tax perspective. So we see smaller to very large landlords who face the same dilemma. So Alan, over to you, and I'll chip in as and when needed.
Okay. Right. Well, good afternoon, everybody. Thank you for joining us today. And I hope you'll find what I've got to say in the next few minutes will be useful for you. So, just briefly a few words about ourselves. Churchill Tax Advisors. We're a specialist tax advisory firm based in London and Essex and offering national coverage. We specialise in tax law, including all those areas listed on the slide, and we welcome all your inquiries. So the agenda for today, I'm going to say a bit first of all about the basics of inheritance tax in general terms, then turning to the specific concerns that landlords have, and talk about investment companies, how they are affected by AHT, and similarly for trusts and partnerships, and then just a quick word at the end about gifts with reservation. So yes, start with the basics. Inheritance tax is charged on a donor's estate at 40% based on the value of the deceased estate at death, and the threshold is £325,000. It's been there for a while, and there's no sign of it changing, which creates a bit of, I suppose you call it fiscal drag. It's also applicable to at 20% on certain lifetime transfers. For example, when you make a transfer to a relevant property trust. Most lifetime transfers are potentially exempt transfers, but if a donor dies within 7 years of the gift, IHT is chargeable on gifts made within that 7-year period. The percentage depends on the interval between the gift and the death, and it ranges from 0% where the gift is made 7 years after death, and then it goes back up to the full rate of 40% for gifts within 0 to 3 years of death. And there are certain reliefs and exemptions available. For example, business property relief, which I will mention in the context of investment properties. So moving on then to inheritance tax and the issues that landlords face. I mean, you're probably aware that a main residence can, in some circumstances, be bequeathed entirely free of IHT due to the main residence nil rate band. But this doesn't extend to properties that you hold for rental purposes. And a business property rental business doesn't qualify for business property relief, whether carried on by an individual or through a partnership or through a company. Thus, when a rental property or property portfolio is bequeathed on death, or a gift is made and the donor dies within 7 years, the transfer is subject to IHT. So looking at inheritance tax as it applies to investment companies, I mean, incorporation is a popular method of holding properties, but it does have a major drawback for tax purposes. And when you use a limited company as a SV as a special purpose vehicle for holding property, if you incorporate a property portfolio, you're essentially exchanging one asset, that's the property portfolio that you hold in your personal name, for another, which is the shares in the property investment company, whose value is based on the value of those same properties. So essentially, the value of the two are the same, and you're not achieving anything in IHT terms if you move your portfolio to a company. And as I mentioned briefly earlier, no business property relief is available. HMRC do not regard the carry on of a property rental business, for IHT purposes as a business that can qualify for business property relief. So you have the exposure there to IHT. Just a brief word. In a family context, there are certain things that you can do. It may be possible to structure the share capital or restructure it if the company is already in existence by using a combination of freezer and growth shares. So that I mean, typically it's parents that would hold the freezer shares, so that the value of the property of the asset in their hands is frozen, and the children would hold the growth shares. So any growth that accrues on the property portfolio would accrue to the children and not to the parents. So that is one thing that you can do to mitigate inheritance tax in a company context. It does involve a certain amount of work, and there's cost involved. And we can assist and advise on that if that's something that you're interested in. Moving on to trusts. Trusts used to be a very common vehicle for holding investment properties, but there was a big overhaul of the regime in 2006 in the days of Gordon Brown and New Labour, which meant that the advantages of trusts for holding properties was substantially diminished, and as a consequence, they're not as popular as they used to be. I mean, the reason for this being that there's an IHT charge going in when the properties go in. There's an anniversary charge on every 10th anniversary, and there's an exit charge. So you're paying IHT at every step along the way with the trusts. So they aren't as popular as they used to be. But it is just worth highlighting in this context that they can be useful for gift relief purposes. Because when a property goes into a trust for IHT purposes, it's a chargeable transfer, but that means the gift relief provisions kick in, so you can claim to defer or the gain when it goes into the trust, and similarly when it comes out again at the end. There is similarly gift relief, so this can be quite a useful vehicle for gifting properties, so that the final beneficiary after a relatively short time of holding the property in the trust, can take that property with the base cost uplifted for CGT purposes. So that is something that is worth considering. So yes, I mean, basically the points that I've just mentioned, and it is important to note that the trustee, who may be the donor himself, can retain control. So it leaves a measure of control with the donor. So yes, just moving on to partnerships. Now, one of the big tax planning advantages of a partnership is the potential inheritance tax saving. And the reason for this is unless the trust meets the definition of a settlement, which can usually be avoided by the drafting of the trust deed, the partnership deed, sorry. Then there's no chargeable transfer when assets are put into the partnership, and hence there's no IHT entry charge, no 10-year anniversary charge, or exit charge. And if you recall, as I just mentioned on the previous slides, those are the big drawbacks that are entailed in having putting property into a trust. So it's possible to get around those by using the partnership structure, family investment partnership structure. So yes, in technical terms, transfer of equity from the capital account of one partner, typically a parent in this context, to another, typically the child, that will be a potentially exempt transfer for IHT purposes, and providing that the donor partner survives the gift by 7 years, then there'll be no IHT to pay, and the IHT starts to taper away after 3 years. And it should be emphasised that the survival of the donor for 7 years, even if they are in good health, is not something that one can determine. These things are always subject to chance and misfortune. So it may well be worth taking out term life assurance if you're placing reliance on this structure, so that if there is any inheritance tax charge, if the donor does die within that 7 year period, then it can be covered off by taking out the life insurance. And just a final point to mention. It's just worth remembering with gifts with reservation of benefit. People normally think of the gift with reservation of benefit regime in terms of the main residence, where a parent gives away some share of the ownership to a child. But it's also relevant in the context of rental properties. It is possible for a parent to gift a share of a rental property to a child and still retain the right to receive the rent. And in this context, there is no gift with reservation of benefit issue arising, so long as the donor doesn't occupy the land, and in the context where it's a property that's being used for rental, then the donor will not be occupying the land. So it is possible to do that and retain the benefit of the rental income. So those were the points that I wanted to make. Just a summary of what I've been saying for your information. Inheritance tax is going to be a reality. It's for any portfolio over £325,000, which is pretty much every property portfolio that we come across. It is there. It's a reality. It needs to be planned for. And if you're currently holding your rental properties in your personal names, then we would suggest that putting your head in the sand, doing nothing, is not an option, because it's an issue, and it would only grow over time as the property values increase. Companies do provide some limited scope for IHT planning through the use of freezer and growth shares. They can be useful if you've got an existing property portfolio and you want to pass the benefit of the growth of that portfolio within the company to your children. And as I said, it's worth remembering how trusts can be used, putting the property into the trust and out again, and taking it out again, and obtaining an uplift on the base cost. Family investment partnerships provide substantial scope for IHT planning, and Churchill Tax Advisor specialist in this area, we talk to a lot of people about these partnerships, and you're more than welcome to contact us after this webinar with any queries, and if it's a structure you're interested in, then we can arrange to provide you with some more information so you can understand your options. And just the final point again, remember that you can gift a share in a rental property and still retain the rent. And thank you very much for listening, and that concludes my presentation.
Thank you, Alan. That's very useful. So if our users, I mean, we've got quite a few users online at the moment, and we are. I've got a couple of questions here. One of the questions is there any tax on transferring properties into a partnership? The answer to that is generally yes. There would be tax when you transfer properties into a partnership. But if you strictly follow the law as it stands and the HMRC's guidance statement of practice D12, which was issued in 1975, and it's been modified a few times since then. If you strictly follow, then transferring properties into partnership, and if you carve the partnership agreements very carefully and the deeds very carefully, then there are no tax implications on the transferring of properties into a partnership with your family members. So, and also the next question I have here is if there are any stamp duty implications of transferring into a partnership. Once again, there are no stamp duty implications as long as you are careful in drafting the documents. People have been asking me questions about transferring properties into a limited company, and we've done quite a few of those, and it's interesting how every time we do one the circumstances and the way we do it is different. There's no kind of a set formula for transferring properties into a limited company, and the same form applies to everybody else. Every one that we've done so far, we've had to change things around because of the circumstances of the client or the landlord, and how much mortgage they have, the arrangements they have with the mortgage companies. All of these need to be considered very carefully. And once you go through the hurdles, there are usually two teams involved in transferring a property into a limited company. One is the tax advisors team, and one is the legal team. And obviously, then you have to coordinate matters with your bank as well if properties carry a mortgage. So it's a process, but a lot of clients that have come to us are benefiting now from the reduced tax that they were paying on the income tax they were paying on the rental income, especially because the mortgage interest is no longer allowed as a tax deduction. So there is at the higher rates. So there are lots of benefits. We have clients where they have introduced growth shares, which Alan briefly covered, and that allows you a certain flexibility to reduce the inheritance tax. But I think there are partnership. In my mind, my view is that partnership structures are more flexible and provide a far better outcome than any other growth shares or transferring properties into a limited company, etc. So if there are any questions, I think I've covered most of the questions that we've been asked. If you've got any follow-up questions, you can contact me or Alan, and we'd be more than happy to help you. Until the next webinar, I hope you have a good summer break. Thank you, Alan. Thank you for the presentation.
Thank you, Jamal.
Thank you, everyone.
Thank you.